what's happening in the cement space, we have with us Ms. Khushbu Lakhotia. She's the Director of Corporates at Fitch Ratings. She's joining us to talk to us about the outlook for the cement sector in the coming year. Khushbu, hi. Thank you so much for making time and speaking with us. First up, do you expect FY24 to be materially better for the cement sector versus FY23?
Hi, good afternoon. So in FY24, we expect cement demand to grow at around 8 to 9%, led by the government's sustained thrust on infrastructure, as we've seen in the budget also, which is broadly similar to the kind of growth that we expect has been seen in FY23. So if we look at the ratio of cement demand growth to GDP growth, cement growth has typically been 0.9x of GDP in the last decade. But this typically shoots up in the pre-election years, averaging about 1.5x, because there's obviously a lot of thrust on completion of ongoing projects on infra as well as affordable housing, where currently also there is a large pipeline of over 1 crore units. So these are the factors which we believe would support demand in FY24. Having said that, on the housing side, particularly on urban housing, where we've seen a very good recovery in FY23, there could be a bit of slowdown as inflationary pressures affect affordability.
Okay, so that's about the kind of growth outlook do you have for the cement pack. But what about the margins? Because in the year gone by, it was high fuel prices, high commodity prices that were putting pressure on margin spreads. Does FY24 look better? Any estimates? What could be the upside?
Sure. So in FY21, the profitability of the cement sector had hit an all-time high. After that, in FY23, profit hit a multi-year low, because as we all know, coal prices shot through the roof. Now, coal prices, which averaged about $350 per ton in FY23, are currently down to less than $200 per ton. So this we expect is going to support profitability. So from over 1,000 rupees per ton, we expect profitability to be down to almost 750, 800 rupees per ton in FY23. But in FY24, we believe that a recovery of around 200 rupees per ton is what is on the cards. Because again, I think on the logistics cost, we believe that there might not be a lot of change. But having said that, the benefit would only come from the cost side. Because on the pricing side, we do not see a lot of traction. We believe that the cement price increase could be restricted to low single digit, because capacity utilizations would remain range-bound. There's a lot of supply pipeline. So, and again, in this year, being a pre-election year, players would typically focus on increasing their growth and share. So in that sense, we don't expect a lot of dip on the pricing side.
Hi, Khushbu. Somat this side. So my question is on the pricing. For the last 2-3 months, continuously we have been seeing cement companies or cement mills have taken price hike, but then again that had to be rolled back. So what is this major reason behind the price hikes not sustaining in the market? Is it the demand, or is it there's too much capacity or too much supply coming in, because of which the price hikes are not sustaining in the market?
See, the demand growth, if you look at per se, has been healthy. High single digit kind of demand growth. But having said that, the rate at which the supply is growing is marginally outstripping demand growth. So in fact, if you look at a 3-year period, the typical horizon that we look at between 23 to 25, almost 150 million ton of supply addition is announced. While we believe that only 75% of it would actually come on stream, but this would ensure that the capacity utilization. So as we know that cement sector has always, at least in the past decade, had surplus capacity, operating at about 65-70% capacity utilization. Now, the rate at which supply is growing, this been in line with demand growth, it will prevent any upside in capacity utilization, which means that the growth is not so strong that we'll be able to see demand price hikes of, let's say, double digit. So that is one key reason why these price hikes are not sustaining, and going forward also, we do not expect a significant price hike.
Okay. Just last one question on from my side, and that is on the fact that you're expecting demand to be around double digit, as you mentioned. But do you think the adverse weather conditions that we have been seeing could impact the cement demand going forward?
So I think what we are expecting is more like a high single digit, 8 to 9% kind of demand growth. So adverse weather conditions, worse than expected heat wave or El Nino affecting monsoons could obviously play spoilsport. But having said that, typically to look at cement demand from rural housing, which obviously is a very big part, one should look at monsoons in the past 2-3 consecutive years, because that is where the purchasing power base is set. So, while there could be a bit of aberration here and there, but we don't think that this poses a major downside risk to the cement demand in FY24 itself. And then there, as I mentioned, there would be additional avenues in the form of the government's focus on completing affordable housing projects and the large fillip coming from the infra side.
Khushbu, any sectoral trends that you can talk to us about with respect to various geographies? East, South India, is there any region that you would want to highlight which will outperform the rest of the pack?
Right. So I think cement is very much a regional market because it's not typically possible to transport cement from south to north. So in terms of regions, purely talking of demand growth, East and Central have the highest demand growth potential because they are the most underpenetrated markets. Having said that, capacity additions have also been the highest and are likely to be the highest in the Eastern region, which is why capacity utilizations and also the prices and profitability would be under pressure. So one market that stands out in terms of profitability and capacity utilization is North, where we've broadly seen that supply additions have been mostly matched with demand additions. So there the utilizations are as high as about 80%, and which is why the profitability is also stronger. South is clearly one market where the oversupply has been the highest traditionally, with capacity utilizations of about 60%. And this is a market where, there could be, we've seen in the last couple of years, there's been a lot of divergence between the mid-sized players and the larger players. So from that perspective, we also see more consolidation or at least a lot of potential takeover candidates in this region.
Okay, Khushbu, we'll let you go on that note. Thank you so much for joining us today.